Every month, checks went out to more than 10,000 people. They looked like exactly what they'd been promised: steady income from a private equity fund that owned real working car dealerships. You could drive past the lots. The Justice Department says GPB Capital raised about $1.6 billion from those investors. And in August of 2024, a federal jury in the Eastern District of New York found that some of the money used to pay those monthly distributions never came from the dealerships at all. It came from newer investors, the oldest trick in finance, wearing a very respectable suit. Here's the pitch: GPB sold private equity funds it described as income producing. Instead of buying stocks, your money went into buying whole businesses, mostly auto dealerships. The idea sells itself. A dealership is a real thing. It has inventory, service bays, salaried staff, cash flowing in every day. Own a piece of enough of them and the profits get passed back to you as a regular distribution. For a retiree who wanted monthly income and something more tangible than a mutual fund, this was a comfortable story. Real assets, real revenue, a check in the mailbox. The number that pulled people in was the distribution. GPB funds sent out an above-market monthly payment, an income stream well beyond what a savings account or a safe bond offered in those years. That yield was the whole gravity of the thing. It signaled that the dealerships underneath were throwing off serious cash. And a distribution that arrives on schedule month after month is powerfully reassuring. It feels like earnings. It feels like proof. As long as the check clears, most people never ask the one question that mattered: where is this money actually coming from month after month for 10,000 accounts? The problem sat underneath in the businesses themselves. According to the SEC complaint filed in 2021 and the case the Justice Department took to trial, the portfolio companies simply were not generating enough cash to cover what GPB had promised to pay out. The dealerships were real. The revenue was real. But the profit that was supposed to fund those distributions to 10,000 people was not fully there. That gap is the moment every scheme like this reaches. You can lower the distribution and admit the fund is underperforming, or you can find another way to make the numbers look like they work. The way GPB made the numbers work, prosecutors said, was a document called a performance guarantee. In 2015 and 2016, the defendants used performance guarantees that were fraudulent and backdated to inflate the income the funds reported. These were executed by an operating partner named Jeffry. Think about what a backdated guarantee does. It lets you record income as though a promise to cover a shortfall had existed all along in a period that had already closed. On paper, the fund suddenly looks like it hit its targets. The reported income lines up with the distributions. The story holds together because the paperwork was written to make it hold together. Follow how that works from one reporting period to the next. A fund closes a stretch short of the income it needs to justify what it's paying investors. A performance guarantee, dated as though it had already been enforced during that stretch, lets the fund book the missing amount as income it was supposedly owed. The shortfall on the statement disappears. Do it again the following period, and the reported performance stays smooth and healthy while the actual businesses keep falling behind. Prosecutors said the defendants used exactly these fraudulent backdated guarantees across 2015 and 2016 to inflate the fund's income. The number investors saw was engineered to match the promise, not the performance. And that accounting cover pointed straight at the real mechanic. If the dealerships weren't producing enough cash and the income was being propped up on paper, then the monthly checks had to be funded from somewhere. The Justice Department's finding was that the distributions were paid in part from investor capital rather than from the portfolio's actual cash flow. Read that slowly. Some of the income that investors received was their own principal or the principal of the person who invested after them handed back to them and labeled as a return. That single sentence is the definition of a Ponzi scheme. The dealerships were real. The returns, in part, were a circle. What makes GPB different from a crude Ponzi is how much of it was genuine. A classic scheme is hollow, no business, just a spreadsheet and a story. GPB owned actual companies with actual employees. That real substrate is what let it run so long and so large across more than 10,000 investors and around $1.6 billion. The legitimate parts gave the fraudulent parts their camouflage. Due diligence that kicked the tires found real tires. The rot was one level up in how the fund reported income and where the distribution money came from, the exact places an outside investor almost never gets to see. The unraveling ran through the regulators and then the courts. The Securities and Exchange Commission filed its complaint in 2021, laying out the alleged fraud and how the funds reported their performance and paid their distributions. The Justice Department brought a parallel criminal case in the Eastern District of New York, and that is where the mechanics went on trial. This is the stage where a private equity fund's private paperwork stops being private. The performance guarantees, the internal financials, the timing of when documents were actually signed, all of it becomes evidence a jury can weigh. And once a jury can see the gap between what the funds earned and what they paid out, the reassuring monthly check reads very differently. In August of 2024, the jury returned its verdict. David Gentile and Jeffry Schneider were each convicted of securities fraud, conspiracy to commit securities fraud, and conspiracy to commit wire fraud. Gentile was also convicted of wire fraud. Each of those counts carried years of prison exposure. A jury had heard the evidence on the backdated guarantees and the source of the distributions, and it found the conduct criminal beyond a reasonable doubt. On May 9, 2025, the court sentenced them, 84 months for Gentile, 72 months for Schneider. On December 1, 2025, President Trump commuted Gentile's sentence. The commutation cut the prison time. It did not touch the conviction which stands. So here's what the GPB case actually teaches, and it's more unsettling than any pure scam. The assets can be real, the offices can be real, the monthly check can arrive on time for years. None of that tells you the returns are real. The only thing that answers that question is the boring part, where precisely the distribution money comes from and whether the income on the statement was earned in the period it claims. 10,000 people got a check that felt like proof. According to the Justice Department, the proof was, in part, their own money coming back around, dressed up as a return on a fund that could not actually pay it.